Join us for an interview with Les Greene, an entrepreneur and investor whose company Lex Associates helps small companies become big winners in their search for money. For startups and entrepreneurs, getting funded for your business is vital. If you're an entrepreneur who wants to learn how to better your odds of raising cash, you'll want to see this.
For my sins, I did spend about 20 plus years in corporate world, and I was very fortunate enough to hold some very senior positions in some large companies. But I always had that entrepreneurial drive, and I was fortunate enough to be able to put that to the test a couple of times. In fact, I did it in a strange way there too, because I did that with my wife. In fact, we've built two businesses.
Okay, let's get into this. Odds are you're not an endless fountain of wealth. If you're an entrepreneur planning to run a business, you're going to need capital ahead of your ability to generate the amount you need. But with stories of the investor market being awash in cash and the constant bombardment of success stories from companies raising tens and even hundreds of millions of dollars, you'd think raising money would be easier, more straightforward. Unfortunately, what we see is only a small sample of winners, with the reality of fundraising being a grind that can often take more than 100 investor pitches to actually raise funds, if you find success at all. So what's the secret to success? We've conducted extensive research on the topic, and the answer is this: it's really hard to tell. Some investors will take bets on unproven business models, others won't. You'll hear that it's all about the team, but then young entrepreneurs with a thin background can gain traction ahead of more wizened business types. Long presentations full of detail versus short, punchy presentations. It really boils down to who's sitting across from you. But despite the fact that research suggests VCs will spend less than 3 minutes reviewing a pitch deck, with only 1% of those receiving funding, there is a way to be successful. And getting the inside scoop is the whole point of today's interview with Les Greene, founder of Lex Associates. In a 30-year career spent investing and helping raise investment, Les has been in front of something like 2,000 different investor pitches. He'll share his insight and experience into what entrepreneurs should do when pitching for funding, watchouts to avoid, what financial metrics to focus on, and more. All right, let's meet Les. I'm so excited to introduce Les Greene, managing partner of Lex Associates, a company that specializes in working with investors to secure investment. And if you are thinking about investment, or if you've been through investment, it is not an easy thing to do. As I was saying last before we jumped on camera, I once had an entrepreneur say to me that the pursuit of investment for their business is soul destroying. And I think a lot of people underestimate what it takes. So the amazing thing about speaking to Les is that he has been on both sides of the table. He has been in the room with the investor, he's been in the room with the entrepreneur, and he understands the nature of those two parties and the discussions that happen in between. So Les, I just want to say thank you so much for joining us.
My pleasure, Robert. Great to see you, and thanks for inviting me.
Pleasure. So Les, let's just start. Tell us about your background and how you got into this business.
Well, I've had a rather unusual approach to this business, Robert. Many of the people who raise capital for you have never actually run a business. In fact, if you're in the City of London and there's just a few hundred people raising capital, the likelihood is that probably 80 to 90% have never actually had to be there at the sharp end. They're very good with the money, but they're not necessarily the people who've had the experiences. For my sins, I did spend about 20 plus years in corporate world, and I was very fortunate enough to hold some very senior positions in some large companies. But I always had that entrepreneurial drive, and I was fortunate enough to be able to put that to the test a couple of times. In fact, I did it in a strange way there too, because I did that with my wife. In fact, we built two businesses, both sort of tech-related companies. The first one was in the middle of my corporate career, so jump ship. We built this business over 4 or 5 years, and that was a full bootstrap. So we used our own limited cash to get the business off the ground, and then we drove it really hard. Fortunately, after about 2 years, Siemens caught us, and then we started working with them for 2 years, and then it got really crazy, as you can imagine. And eventually, the largest distributor in the UK bought us out. So that was quite a nice result. I went back to corporate world and had another 10 years there. But around 2003, so quite a while back now, I decided I'd had enough and I wanted to go again. So this time we raised capital, as you were just saying, and this was about £3.5 million pounds sterling that we raised. Got the business off the ground, and then again pushed it very hard. And in about 4 years' time afterwards, we were then able to list it on the stock market, on AIM in the UK. So that was exit number 2. I then decided that the thing that we'd always wanted to do, and this is really where we came in, even with the second business, was to help other people who were on that journey. Now, you can't just jump into the private equity world or the corporate finance world in London. You need qualifications. They take time to get. Most young people coming out of university, it's a couple of years to do it. The people who'd actually put the money into our second venture agreed that I could work for them part-time and work in their sort of private equity area. It was meant to be a 3-month contract just to see how things worked. I was there for 3 years and got all my qualifications. And in the end, we bought out the little private equity firm that they had. And that was the basis of Lex Associates, which is what we have today. So we've been trading for 12 years in our own right. We are regulated by the Financial Conduct Authority in London. And what we do is 2 things, really. One is we do the corporate finance work for people. As we look at their businesses, decide what they need to do to speak to investors. And then the second part is we then go and find the money. And although when we started the business 10, 12 years ago, we had a large number of high net worth individuals and ultra high net worth individuals, today we generally just work with funds. So we have a crop of about 225, 250 funds that we know in the UK, Europe, and a few in America too. And they're the ones that we would go to raise capital for business.
So this is a question I've been dying to ask somebody in your situation, which is, you mentioned earlier that a lot of the people that are trying to do what you do don't have a background in business. And the question I had is, how many investors have a background in business?
If they're high net worths and ultra high net worths, nowadays quite a lot of them do. In the UK, the Sunday Times started a survey just over 30 years ago that looked at wealth. So they have this wealth index that they produce once a year. And what's fascinating is if you go back to the very first one, 80% of all the wealth was inherited. That's only 30 years ago. And today, 80% of the wealth is now self-generated. So there are far more people. It is amazing. It's a complete switch around 80-20 in 30 years. So when people say, yes, there's a lot of rich people about who have had inherited wealth, that used to be true, but it's not so true now. Most people have made their own money. And so those people are looking to do stuff with the cash that they've made. And so a lot of the cash from individuals is definitely with people who have made money and are in business. But if you go to the funds, again, I suppose you could say the funds themselves are collecting cash from people who have made money. So they're in pension funds or they're in high net worth funds that they're managing for them. So ultimately from that, but the people who are investing the cash, actually doing the investing, are not necessarily people who've had any business experience.
Okay. So how many, just out of curiosity, how many entrepreneurs have you spoken to? How many pitches have you received from entrepreneurs who are looking to raise cash? Just a rough number.
Okay, well, here's how we do it. We presently receive about 15 business plans a month. Okay, so that's nearly 200 a year. And we've been doing this for over 10 years. So that's a couple of thousand.
So there's the math. Okay, so let's focus just on the mistakes that people make, okay, when they're thinking about this. So what are the most common mistakes that an entrepreneur makes when they set out and they get to the point of sending you a business plan? What are the things that they're not taking into consideration that they absolutely have to if they're going to be successful in at least getting a meeting with an investor?
Okay, in terms of the mistakes that most people make, I'd say first and foremost, they're just not succinct in what it is that they want to get across as a message. Too many people think about all of the aspects of their business. They're focusing on what makes their business tick or the features of the products and services that they sell. And they're not really thinking about, I'm pitching this to an investor. And if I'm not pitching it to an investor in their own language, then I've got a problem because they may not understand. Remember, these people, like we, are receiving many, many business plans every month. And you don't have a lot of time to be able to decide good or bad. So you need a really punchy, succinct message. This is what we do. This is the business that we're in. This is the kind of return that you could get from investing in my business, and this is why you should come with me. Most people don't do that. I generally say to people, if your investment pitch deck is more than 11 slides, it's too long. I can't tell you how many I get that are in the 30s and 40s, and I just haven't got time to read past the first 10 or 11. I just want you to tell me, what do you do? Why are you doing it? Who have you sold it to? Etc., etc. So I need those key messages, and if you can't put that over, that's a problem. The second thing I think is just to add to that is
please.
They don't really focus on that sort of financial message for an investor. So if you like, it's bridging the gap in terms of the lexicon between both parts. I mean, the reason we're called Lex Associates is because we believe that we speak both languages. We have a lexicon that converts from business into investment. And that's really what people need. They need to be able to turn around the sort of strange language that the investment community speaks and somehow get in there. And I guess that's why we believe we need to exist. You need professional help with people who can actually speak both languages.
Okay, so, that is interesting. Could you explain that a little bit more? Like, what exactly does that mean from a content standpoint?
Okay, the kinds of material that we produce is probably the way to answer that question. We find that most investors are looking for a really short summary. Sometimes they say it's a one-page summary. We tend to go for a 2-page summary, but that's the sort of thing. And in that document, we would focus on, tell me in about 3 paragraphs, what do you do? You know, what business are you really in? I mean, if you want, some people talk about an elevator pitch and you've got 15, 20 seconds to do your elevator pitch. Well, it's a little bit like that. You've got a little bit more space than that in 2 pages, but really need to understand, why do you exist as a business? What point are you? And it's sometimes quite difficult to do that. Obviously, the bigger the company, the more difficult it is. But if it's a small startup business and you're in a space where there are others, what is it that you're doing? We then normally say, we go back to that pitch deck I just mentioned, which might be 11 slides long. And in there, you can fill it out a little bit more. But it's not all about the products and services. In fact, it's very little about that. Yes, we do need to know that you sell this particular type of software, and this is the sort of thing that you're doing with your software that's very clever. But don't forget, there's lots of other aspects to this as well. I personally feel that the way you should do it is sort of top down. So we start with the strategy, start with the end in mind. What is it that you're trying to achieve? So, for example, coming right to your point then, Robert, how long do you think you're going to be running this business for? If you're going to be running it for 5 years, well, then that's a relatively short-term period of time. You probably have an idea of who you're going to sell the company for. And certainly when I started my first business, I knew that we wouldn't be running it for more than 4 or 5 years. We had an idea who would take us out, and sure enough, that's what happened. If you're going to be running it for maybe 10 years, and you think it's a longer term business, it's a different sort of investor that you're then going to be pitching to. Because many of the funds in the UK, if it's longer than 5 years, are not interested. And I won't go into the details now. I could do if you like, but it's because of the way that their funds are put together. Closed investment funds, as they're called, only have a lifetime of 10 years. And they spend 5 years investing and then 5 years trying to get out of the investments they've made. So, if you're a 10-year long, it's a different kind of person that you're looking for, or a different kind of fund. So start with that sort of strategic viewpoint, where you're going and the end in mind. And then we come down to some of the tactics. Now, in an investor pitch, those tactics are less important, but from a business point of view, they're important. But certainly from your pitch perspective, you don't need to go into all the details about the product and so on, just high-level information. But then we get down to the real nuts and bolts, which are things like the financial returns, how you present that financial information to your investor. And it's not just as simple as a profit and loss and a balance sheet and trying to put that over. It's things like the internal rate of return, the money multiple on the investment that they've made. These are all the kinds of measures that investors look for that your average financier doesn't need to. Does that answer your question?
Yeah, that is actually really useful. And so I just want to make sure that we've captured the mistakes people make. So you pointed out, two good ones. Are there other mistakes that are common to the plans that you see?
Well, I think there are actually, because often the financial figures themselves, if I may say so, are a little bit naive. I mean, you wouldn't believe how many times I see people trying to tell me that they're going to grow the business by 500% in the first 2 years. And it may well be that that's based on the cash that they're getting. But when you sit down and say, well, okay, now show me how you're actually going to achieve a 500% growth in investment. Let me see how that's going to be done. Let's go through the numbers. What are the assumptions you've got underlying it? Certainly in 99 times out of 100, they would just be completely inaccurate. And any investor is going to look at that and say, no, if you can't get past one and you don't understand the financials, well, I'm not interested in investing in your business. Because put it this way, I give you X hundreds of thousands of pounds. I'm going to expect that you look after my money and that you've got some financial management processes in place that mean that it's not going to be wasted. Having said that 500%, I will just say this. I had somebody pitch us at the end of 2019 who was claiming they could do 500% investment, 500% growth rather. And we did look at it, and actually I believed them. And then we did raise them £1 million in short order. And guess what? They did deliver 500% growth as well. But you see now, why were they different? Well, the reason they were different is that they'd identified the routes to market. They hadn't got a large customer base to start with, but those customers were already starting to say, we love what you do, we love your products and services, and we are likely to buy. But they weren't buying because the company didn't have a strong enough balance sheet. And we could see that. So the £1 million of investment effectively shored up the business, and then that delivered it. And I guess that's the final point, which is when you're pitching for money, often people come with this notion that it needs to be a high number. It's got to be 5 million, otherwise it's not worth doing it. There's too many people, I think, in the market saying it needs to be a high number. Many times when people come to us, we actually say, you'd be better off taking maybe 500,000 now and then taking the others in stages, because from the cost to them of their most valuable commodity, which is equity, is generally a lot less by taking a small amount initially, proving that you've delivered something and you've succeeded in something, and then moving to the next stage. So it's that sort of staged investment. Now, I appreciate that's effort for the management team for most people. You come to us, now doing my sales pitch, Robert, if people come to us, what we try to do is to take that weight off the management team. If they were raising the money themselves in the market, of course, it would be hard going doing that because you'd be constantly raising capital. But if you work with a professional firm of corporate finance people, they should be doing the work for you, and they should be staging those drawdowns of investment.
Right. Interesting. So I'm going to come back and ask you what the best entrepreneurs do above and beyond, not making the kind of mistakes you referenced. But I want to actually focus on the investors themselves. So, I have heard so much contradictory information out there. Like, there's tons of money around. You'll have no problem raising money. It's all about investing in the team. It's all this, it's all that, and again, to the point about capturing the story, I've heard so many times, like, it's too short, it's too long, it's too short, it's too long. Like, it's conflicting if you're an entrepreneur, what you're hearing out there. So what is it that really makes an investor invest? Assume they get the kind of the mechanics of their story right. Leaving that aside for a minute, what makes an investor invest?
Okay, let's break this down, because there's several things here, Robert, and you're right. Many people say I would say there's a wall of cash. In fact, there's more money every year coming into the marketplace, and it's hard to place it. It really is difficult for investors to place it. Generally, we split the market, I suppose, into two categories. You've got the general investors. In the UK, and certainly for people who are based here, there's a very, very strong tax incentive, something called the Enterprise Investment Scheme that the government created many years ago. And that makes it really easy for people to invest, because there's so many great tax breaks for investors putting money into entrepreneurs, that it's hard for them to go elsewhere and invest in a different way. But not every business suits that kind of investor. And then, of course, you've got the specialist investors, and that's the second category. And these are the ones who are looking for something a little bit different. So let me just sort of try and speak in the round about both of those, and then come back to one or two specifics on each. I would say people are looking for something that, we use this word a lot, but disruptive is the word that's often used. I had this explained to me once by an academic who said, well, if we've got one area where there's already a market for something, and we have another area where there's something that's a market already, but then there's a crossover between the two, like in a Venn diagram where you've got a crossover between those two areas, that's where you can get some disruption. So I suppose if you think back to the days when Amazon first started, they had a bit of technology, which sits in the technology camp. And then obviously they were taking books, in terms of, that's where they started in terms of selling books. And they created this Venn diagram of, now we can sell books and we can sell them online, and we can then start to do everything else that we do. And if you think where they've gone in 20 years, it's quite remarkable how that disruptive piece of the Venn diagram has just grown to create e-commerce and all the other things that come with it. Another area that I think is really important to many investors is recurring income. In my career, I was fortunate enough to run a global public company on NASDAQ, and 72% of our income was recurring. So just think about that. It means every year I only have to find another 28% to achieve our targets. I mean, that's still difficult, because that means you've got a lot less clients to go for, but that's the kind of thing that people are looking for. Software as a service, platform as a service, there's many ASs, if you like, ASS, that are available for people to go at. But recurring income is now really hot, and people look for that. But on the negative side, of course, they're not looking for a fad. We don't want something that's just kind of like a short-term thing now. Let's jump on this bandwagon and see if we can make some money and then move on. They want something that is still a long-term market and will give them protection. And when you look at investors, most of them are very risk averse. They really look at the downside risks. They'll ask all the negative questions they can, which can be very frustrating if you are the business and you've already covered it in your mind and you think that everything's okay. But just think about it from their perspective. They're giving a lot of cash to you and they're thinking, well, what happens if this happens? So, for example, we've just been through a pandemic through 2020 and 2021. If you were investing at the beginning of that into, let's say, a restaurant in the centre of London, and it needed a couple of £1 million to get it off the ground, it would seem like a great idea at the time. But if you were then thinking, well, did anybody ever think there might be a pandemic that would cause this? Somebody's got to think of those sort of downside risks and think, how do we accommodate that? So in terms of the funds and why they want to invest, I'd say something that's disruptive, something that gives recurring income, definitely that there's a proven demand. Have you proven that there's demand for your product? And if you have, that makes all the difference in the world. Doesn't mean you have to have a huge amount of revenue coming in, but at least you've proven that there is demand for your product. And then the last point on that, I'm just going to point to something again in the real world. A client of ours from about 5 years ago, they were a mid-sized company in their field. They were selling a product outright, and they wanted to move into renting this business, renting their products. So they came to us to raise capital. And when they came, the smart thing about these two young entrepreneurs is that they'd actually spent 9 months with their own money, taking about 10% of their sales and renting those products rather than selling them. And it proved very clearly, A, that there was a demand for this, and B, that there were great returns from what they were doing. And it was only a small slice of their business that was affected, but boy, was that a powerful message. Made the raising of the capital really straightforward. And in fact, now they're number one in the market in the field that they're in. And they have a huge rental book of unexpired rental income, which makes the business very valuable.
So it used to be said that 10-20% of an investor's portfolio would actually pay off, and the rest of those investments wouldn't. And obviously, an investor is always looking to mitigate that, those losses. But I'm curious, what is it today? So, given the due diligence that an investor goes through today, what does an investor typically expect to see from their portfolio of products?
Okay, I'm going to answer this question from a couple of different angles, which hopefully will give you a feel for things. There's been 3 major surveys that I'm aware of over the last 30 years, looking at the differences between investors in the US, Europe, and the UK. And when the first one was done 30 years ago, I guess the UK and Europe were really similar to each other, and the US was quite different. Silicon Valley and everything goes on there hasn't really changed. It's as aggressive as ever, where most investors tend to be looking in the 1 in 10. So they think the one investment in 10 that they make will pay for all the other 10 and make a good return. And they know that those other 9 are going to fail. The thing that they do is that they get in early, and if any of those 9 are looking like they're about to falter, they get out. So they don't waste time on those businesses. It's a case of they succeed or they get killed, and then they focus on the one that they need to make up the rest. In Europe, again, going back 30 years, it was a view of we don't want to lose money. So we're going to put money in where we think we should put it. We'll be very careful about the process. And if things start to falter, we will continue to support them, but we'll just be a bit careful about how we do it. And the UK was the same. Roll that forward now, and the most recent one I've listened to, went to the presentation of, was about 3 years ago. And what we're seeing now is the Americas still the same sort of approach and seems to work for them. Europe is very much as it always was. It's moved a little bit, but it's still very much about protecting the downside. However, Britain's moved, or the UK's moved to a situation where it's much closer to the US. It's not anywhere near where the Silicon Valley is, but it's certainly further away than Europe. So that's a good sign, I think, for entrepreneurs, because now we are less risk averse in terms of the way the investment community works here. So that's certainly a key point, I think, Robert, in terms of how that investment side is thought through. In the UK,
I'm curious about that, though. Sorry, Les, go ahead.
I was just going to say, but just now going to the specifics in the UK and what people are looking for, there's 2 measures, really, that most investors look for. One is a money multiple. I think I mentioned this earlier. The money multiple is looking at purely, I put in £1 million, and then I'm looking for that money to deliver me a multiple of that over a different period. So if I'm investing for 3 years, I'm typically looking to double my money. I'm investing for 5 years, I'm typically looking to treble my money as a minimum. So it's 2 times or 3 times, depending on whether it's a 3-year or 5-year cycle. So that would be normally the minimum. The other thing to think about, though, is what we call internal rate of return, which is a percentage. Relatively complex to calculate, but what that really means is that most people are looking to try and get between 25 and 30%, 30% being the sort of gold standard of growth in the value of my investment every year. And that's a sort of compound number. So just taking that simply, if you did 30% and then add a 30% to that and then another 30% to it, that's what you're really looking for in terms of the growth. And most funds want to pass both of those thresholds when they get to a point where they exit.
Okay, so can you, if you wouldn't mind, just dumb that down so that that we'd understand. So if someone's investing for 3 years and they want to double their money, they're investing 5 years and they want to triple their money.
Yeah.
Explain again, what does that, the 25, 30% mean relative to that number?
Okay, well, actually, I will answer that question, but I'll also give you a specific example because this can help people in terms of thinking about values of businesses and so on, because that's another area that is so critical to all of this. I said a few moments ago that the absolute strongest value that people have, the currency that they have in their business, is equity. And of course, you want to give that away, give as little away as possible when you come to an investment round. But let's say, forget the value of the business. Somebody's going to invest £1 million into your company. And if the plan is that the start with the end in mind is that we're going to sell this after 5 years, that investor will be looking for at least £3 million back, probably more. But let's just say 3 million is the minimum that they would want. So if you think that you're going to sell the company for between 10 and 12 million pounds in the future, so keeping the math simple, say 12 million pounds, well, the 3 million return they want is a quarter of the 12 million. So that means you'd have to give them 25% of the business now in order that they would feel comfortable that they could achieve that. Now,
right. Understood. That's a great example.
So that's the simple way. Now, okay, many people say, oh, I'm going to sell this business for £100 million. Well, if you are saying that, just go and have a look how many businesses actually ever sell for 100 million. And you'll find there are precious little of them compared to the number of companies that are in existence. So again, just try and be realistic. Go to the marketplace, have a look what prices are paid for businesses of similar to your type, similar characteristics, and you'll probably find it might only be 10, 15, 20 million. You might be quite surprised how small the number is. And then say, well, okay, so now if it's 20 million and someone's looking for 3 times return, I can probably offer them slightly less of the business at the outset.
Okay, so we've covered off the idea of, like, when you're making a presentation, make sure that you're super clear. We've talked about, the kinds of things that investors are looking for, what makes them invest. But there's another dimension to this, which is how sexy the company's got to appear. Mm-hmm. And let me give some context to the question. Remember a few years ago, blockchain came on the scene and there was a rush of money into blockchain. And it seems like that there is a disproportionate amount of energy and attention paid to really leading edge business concepts or leading edge technology, which would seem to work to the exclusion of more traditional businesses that might be playing in a very traditional space, but have a unique way of addressing that traditional space.
Sure.
So I'm curious about that. What's the balance between being, something that is coming from a very tested and tried sector versus something that's quite leading edge?
I think I'd put it this way. There are generally 2 types of funds. There's those which are mainstream, and they would continue to invest in the mainstream types of business. And that they're solid, they have a very clear definition of the types of companies they want, and they will always invest in those. And they wouldn't be really pushing the boundaries with an investment in, let's say, cryptocurrency, blockchain, whatever it might be. That would be just a little bit too racy for them. They'd want to see that happen. However, there are a number, and a very solid number, of specialist investment funds. Now, I'm going to separate out blockchain and crypto just for a minute, because to some extent, when the investment was starting to go into those, that would still be in my fad category. I'd still think of them as a very early stage. But there are these specialist funds, and we certainly deal with them. We had a good experience with one only this last year. And they're looking for the much more technical solutions that there are for problems. So it might be cybersecurity or very deep technology. And they're the kind of things that mainstream businesses or mainstream investment funds can't cope with because they don't have the knowledge and the skill or the understanding. And these specialist funds pick up that. I guess you could say then there is a third category, a third way, and they're the ones that would be driving the things that are right at the edges, Robert. These would be the the funds which are going to be investing in businesses which are in something that is just coming along now, catch the wave, really try and drive it now on the hope that this is going to be something really big. And this is, I guess, why Silicon Valley and America generally, their approach to investment is the way that you catch those and you get really, really big returns. I mean, often it's said, how is it that the US manages to find so many billion-dollar businesses and the rest of the world can't do it? Well, it's interesting now that in terms of the number of unicorns that come along, there's far more now coming from the UK. I think we're now number 3 in the world in terms of how many come from our country. And certainly in terms of figures I saw not so long ago, there were more unicorn companies created in the UK than the whole of the rest of Europe put together, which is quite interesting. And again, this comes back to that point about the fact that the UK is changing its investment approach and it's starting to become more speculative than it was before. But in terms of categories, I definitely say 75, 80% of investments would be by those mainstream funds that are looking for something that's solid, reliable, and works that way. There's probably another 15%, which would be those that are the specialist investment funds looking for deep tech, something that is, it could be deep engineering, could be robotics, it could be artificial intelligence. So something that's established, but it's still quite complex and difficult to understand. And then you've probably got the 5%, which is looking for that, what I'd call, for now, it looks like very, very speculative or maybe fad-like, but there will be people who want to go after those.
So we started the interview by talking about the mistakes that an entrepreneur makes when starting to pitch for investment.
Yeah.
Think about the best examples that you see out there. And obviously this is beyond just a simple written document. What are the common qualities with the most successful entrepreneurs that you've seen when it comes to packaging their story up and pursuing investment?
Well, I think if you take that very basic premise of people buy people first, service second, and product last, that's always been my mantra in business. People that lead successful businesses drive those businesses forward at pace, but they've got to have people skills that not only lead those who are working for them and driving the business with them, but actually are able then to communicate properly with, say, the investment community if that's where they need to go. And I'm not saying that everybody has to be ultra charismatic, because that's not true. Not all leaders are charismatic, and not all the most successful people are like that. But if you're an entrepreneur, you have to be able to communicate with people. It's absolutely critical that you can do that. And so certainly for me, I think that's one of the things that is high on my list, because if I'm going to put this person in front of an investor, they have to be able to communicate succinctly, clearly, and get their messages over. And if they can't do that, then we're probably going to be struggling. This sounds very old-fashioned, but qualities like honesty and integrity, and then kind of leading from the front, not asking anyone to do anything that they wouldn't be able to do themselves. Really important messages too, actually, because I think that's what there's some of the characteristics, again, that people do look at. Investment funds do go and check you out in a lot of detail, and that they'll make sure that your past doesn't come up to be a problem in the future. So, I think those skills are definitely important.
So character counts.
Oh, big time. Absolutely, yeah. Because people are buying people first. Yeah. The ability to sort of start with the end in mind and be able to paint the picture of where you go and where the business is heading and what business are we in, just to be able to explain that, again, is really important. And I apply that to our business too. If I'm trying to explain to people how we are different, perhaps, or we believe we're different to many other corporate finance houses, how would I do that? Because there's quite a few around, and many very, very, very good ones as well. Well, I would work on this basis, for example, and say, well, we've sat on both sides of the fence. We have been entrepreneurs. We've built successful businesses and made an exit. We spent over 10 years speaking to the investment community, finding out what it wants, trying to understand the language of how they operate, and then present information to them in a way that they like and they want. So we're building that bridge between the two parties. And one of the things that many entrepreneurs say to us, and certainly would have been true when I was an entrepreneur, I don't have time to do all the bits and pieces that are necessary for investors. I don't have that time. So my view is, well, okay, if I come to you and say I'm going to help you raise money, initially I want to find out everything about your business. You know, we've got a pretty good understanding of how business operates and we can talk your language. But tell me everything. Tell me all your problems. Don't hide anything. Just give us it all, warts and all. We'll sort it out. Then we can help to paint that picture, because we've got to sell them. So we would then paint that picture and then not expect the company to go talk to investors until it's somebody seriously interested. So you see, in a few words there, I've tried to explain the differences of why we are different to other corporate finance houses. And that's what we think that businesses need to be able to do, just clearly explain that. Far too often what happens is that they get buried in the products and services. It's straight into, this is the XYZ product that we've got, and this is why it's the best in the market, and this is why we can sell it. And unfortunately, that's not really what investors are looking for.
So flipping this question around, what does a bad investor relationship look like? What should an entrepreneur be wary of when getting into business with an investor?
I think, I mentioned honesty and integrity from the start. So let's say one of the worst things you can do is try and hide information from investors up front. So if you've got a financial problem, you know, you have a loan, for example, that is a bit horrible. You had to take it at a time because it was a bad...
Oh, sorry, Les?
Yeah.
Sorry, I just want to explain that question, because my question is, and I'll ask it again, but I'll just explain. There are a lot of horror stories out there with entrepreneurs in terms of bad experiences they've had with investors.
Oh, I see.
I'll give you a great case in point. I'm working with a tech firm right now that absolutely needs to raise capital, but because of an experience they had 25 years ago, in which the investors removed them from the company. So they are absolutely gun shy about going into it again. So I'll ask the question again.
Okay, that's fine. Sorry about that. Yeah.
So, no, fine. So Les, what does a bad investor look like in terms of, the kinds of things that an entrepreneur should be very wary of if an investor is looking to secure this kind of relationship in the business, control in the business? Like, what are the watch outs that an entrepreneur should have when considering an investor?
Okay, well, in terms of considering an investor, you have to do your due diligence on them the same as they're doing their due diligence on you. What does that mean? Well, go and speak to some companies that have already worked with that fund, 3 or 4. Ask those difficult questions about how it was during the pre-marriage negotiations, if you like, and then how things have been post-marriage. I think the kind of war stories that I come across regularly and I point out to our clients to be wary of are things such as really complicated, difficult investment agreements that take months to negotiate, bound up with areas such as the ability to take back shares from the founders of the business, forcing those founders to effectively re-earn the shares in many cases. Then, in the same vein, allowing the investor to take people out of the company almost at their will if there's non-performance, and leaving many areas grey rather than absolutely black and white about what is good and what is bad about the performance of the business. It can't be underestimated that the lengths that some people will go to try and get their financial returns, because at the end of the day, they're driven to get the return that their fund requires. And I'm not saying all investors are like this, because they're certainly not. But there are many out there who are close to charlatan, should we say, and can leave an extremely bad result for the company concerned. So, yeah, do your due diligence, check them out, and go and speak to other companies. It's absolutely essential that you do that.
That is great advice. So thank you for that. So my last question is this. If an entrepreneur is considering trying to raise some investment in the next, say, 12 months, what should they be getting in place? How should they be preparing themselves before they actually are actually ready to go out there and pursue investment?
I say to companies that you really have to have a minimum of 12 months runway of cash. You normally need more than that, but 12 months. Without putting too fine a point on it, investors smell blood in the water. You know, if they think that you're starting to get tight on cash, then they're going to be coming in and trying to drive a hard bargain. And the process really does take a long time to complete. You know, I can remember when we first started our corporate finance house 12 years ago, you could complete a deal in 3 or 4 months. But it's getting more and more complicated to do that, particularly with equity. Debt deals are faster, but equity deals can take 6 to 9 months. It just is much more complicated. And certainly post-2008 financial crash, it's got slower and slower. So don't underestimate how much time it takes, and make sure that you've got a bit of a war chest of cash in play. The second thing I'd say is start building up an online data room. It could be just a large database online somewhere that you have, you know, whether you use one of the tools like Dropbox or something similar, and just build up the information, the basic things about your company that you're going to need. And that would mean things like certificate of incorporation, articles of association for the business, your financial statutory accounts that you've filed for the last 3 or 4 years, maybe copies of bank accounts. If you do VAT returns, having those in there, contracts for your employees, contracts for your customers and suppliers, the things which are, every company has them, they're there somewhere, but just make sure that you've got them ready, and then you don't have to scroll around at the end. And it also makes you look much more professional when somebody asks initially, can I have a look at the due diligence? I would add to that employment contracts. Now, many firms, especially young firms, don't have everything recorded. Sometimes particularly contractors are on a simple contract. Try and organise it such that they're on proper contracts and there's consistency across the board in terms of those contracts. On a legal side, it's worthwhile bringing in the documents you might have for rental of accommodation. You know, it's likely that you're in a rented office. Make sure that's available and people can see how long you've got left on the lease. And then finally, make sure you get a good non-disclosure agreement. Very easy to organise, but make sure you've got something that's in place you're ready to exchange them with potential investors before you share that information to them and a broader community.
That is great advice, Les. Thank you so much. Just one last question. You referenced in the answer to that, equity versus debt. So for the average entrepreneur, can you just explain the difference there?
Absolutely, yeah. Let's say that equity in a company, as I said, it's your currency. It's your future stake. It's the way that you are going to make money from this business. And therefore, the more of it you have, the bigger the return you're going to have at the end. So equity is the one thing you want to try and hold on to at all costs.
So equity is your interest, your shares, the percentage that you own of the company.
That's correct, yeah. And generally, when people create a business, it's ordinary shares. They're very simple shares. They're the basic form of shares. And mainstream investors will take ordinary shares, but they often take shares with special preferences over them, hence preference shares, which means that they are often protected if things go wrong. So that might mean that if they invest £1 million into your business, they take the first $1 million out if there's a problem. So, that's the kind of preferential treatment that they would get. And so that just sort of comes with the territory. But that's the situation with equity. Now, of course, debt is a great alternative because generally there's no cost to you in equity. I'll just explain special conditions on that in a second. But generally, debt is just money that you might borrow rather like a mortgage. But the downside to that, in the same way that if you own a house, you've got an asset and then you can get a mortgage against it. With a business, that asset tends to be personal guarantees from the owners of the company, because there often aren't any other assets that the bank can give you. Now, we have recently completed a transaction with a new lender in the market in the UK, and there are more and more of these coming in that are prepared to lend to earlier stage companies. It's much more expensive money, and their debt it is debt, but it looks a lot more like equity in terms of the way that it's managed. In other words, you don't pay very much interest on the go, and it tends to be at certain points down the line that you then have to pay it back. And that's starting to create a sort of semi-position between debt and equity. And I think we're going to see a lot more of that. But for now, my advice to people would be, if it's an early stage company, take the minimum amount of cash that you need so that you minimize the amount of equity you give away. And then when you can, and you've built the business up and you've proven that it's successful, sure, you can take some more equity, but try then to take debt as well, because then you're minimizing the amount of your shares in the company that you're giving away. And you're kind of leveraging the business, as we call it. You're using the fact that you've got now a stronger business to have debt on board rather than equity.
Great. Well, Les, that is immensely insightful. And I know that entrepreneurs that listen to this interview are going to get a lot out of it. So thank you so much for taking the time and sharing your wisdom with us today.
Robert, it's been my pleasure. And I really do hope that people get something out of it. I'm delighted. Thank you very much.
Thanks. Thanks for sticking to the end of our interview with Les Greene, founder of Lex Associates. For startups, getting funding is absolutely crucial, but it's challenging. We hope the insights gained through our interview with Les can help you on your journey towards starting or growing your business. As always, I want to give a big shout out to my amazing sponsor, the Innovation Hub at Carleton University, dedicated to helping create leaders and new business ventures. Find out more at www.carleton.ca/Innovation Hub. And please remember to hit like and subscribe for more great stories of inspired entrepreneurs.